The next section we're going to cover is option IQ strategies. Now, I mentioned during the class that there are 3 strategies that the option IQ software is set up to use. So we're going to talk about each one of those strategies. I'm going to kind of compare the pros and cons to each and help everyone kind of understand what's available as far as different strategies to utilize depending on market conditions. So to begin with, option IQ strategies. All of the option IQ strategies that we have, or option strategies that we have, are short or selling premium strategies. Again, our whole focus with the software is selling options to generate premiums and then essentially buying options to protect those options that we've sold. So the following strategies that I'm going to teach you are non-directional strategies. These are strategies that we believe you can use whether the market's going up, down, or sideways. Now, utilizing these strategies, it's really important because some of these are pretty complicated strategies, so it's really important to just understand essentially the basics of what you're doing. You don't have to get in and know how to set these up. The software is going to do all that for you. We just want to make sure you understand the general idea of what these trades are doing. So, to begin with, we have the iron condor, which is considered to be the most aggressive, but it's also the most common choice among our members or the people that use our software. It's also traded in lower volatility. So markets that have low volatility are going to be the markets that we use this type of a strategy in. The next one's known as the eagle. We believe, based on our opinion of this trading strategy, that it's less aggressive than the iron condor. It also is a market neutral. It can give you better results in a bullish environment. So this one actually kind of, you know, in a bullish market like we've been in recently, this one can be a great strategy to utilize because it tends to do, better in an upward trending market than it does in maybe a sideways or down moving market. So kind of a market neutral strategy. This one can also be traded in lower volatility, but you can also use it in higher volatility. And then the last one we call the hybrid. This is our most conservative strategy, and this is the flagship strategy for high volatility. So if we get into a market where the volatility starts to pick up, and when I'm talking about volatility, I'm talking about the big swings in the market where it's going up a lot and going down a lot, and it's kind of, there's no rhyme or reason to what it's doing. Those are the type of markets that we want to be using the hybrid strategy in. Let me talk further on this volatility concept. Whenever you're trading our strategies, more volatility will equal more premium. In other words, you're going to get paid more money or more premium when you go and try to execute a strategy in a market where there's a lot of volatility. That's because there's theoretically more risk in that type of a market. The more volatility that comes into the market, not only the more premium are you going to be able to make, but also the larger your spreads are going to be. So when the market starts to get volatile and it starts to move up and down a lot more, our trading boundaries are going to actually get wider. And that's going to be something that's just going to naturally happen as volatility comes into the market. So that's one of the I guess, indicators that we use when we're setting up these trades in the software is that volatility. So as it increases, you're going to see that dramatic effect on your trades. Okay, the next slide says utilizing the volatility index, or the VIX, for preferred trades. Now, this is important. The reason why we have a preferred trade in the software is because the preferred trade follows this VIX rule or VIX guideline that we have. What we do is we utilize the VIX and we determine where it's at on a daily basis. Okay, so when it comes to the VIX, here's what the guideline is that's being used for your preferred trades. So if the VIX is greater than 10, but it's less than or equal to 20, then we recommend setting trades with 45 to 70 days, and we recommend trading iron condors and the eagle strategy. If the VIX goes up and it is greater than 20, but it is less than or equal to 25, then we recommend trading a shorter term period, 35 days to 55, and we recommend condors, eagles, and hybrids. So you'll notice as the VIX is starting to pick up, we're actually recommending that your strategies become more conservative. The next one is if the VIX is greater than 25 but less than or equal to 35, we're going to drop the time frame down even more, 30 to 45 days, and this is where we're going to do iron condors, eagles, and hybrids as well. And then lastly, if the VIX is ever greater than 35, we're going to recommend that you do not set any new trades until the volatility settles. So again, this is the guideline that is behind the preferred trade. So the preferred trade follows the P factors and the time periods and all that. But the other thing that it follows is it follows these VIX guidelines. So for those of you that were interested in knowing how the preferred trade worked, this is kind of what goes into it as an additional piece of the strategy to be able to make sure we're using the right type of trading strategy and the right time period when we're setting these trades. Okay, first let's talk about the iron condor. So if we were placing an iron condor with, say, 60 days remaining, we're going to sell a call option above the current price of the market, and we're going to sell a put option. We're going to simultaneously buy an option up above the one that we've sold, and simultaneously we're going to buy an option below the put that we've sold. This is the iron condor. Now, a couple points here. The iron condor, you're selling just multiples of one. So you're selling and buying one of everything. You could do 2, 3, 4, depending on how much money you have in your account. So you can do multiples of these. And the iron condor only has what's called outside protection. So the options that we're buying are on the outside. And they're a minimum, or typically, 20 points between where you've sold your option and where you're buying your protective option. So that is the iron condor strategy. This one should be familiar to everyone because we've been talking about this one as we've gone through the class. As far as the iron condor strategy goes, when we're talking pros and cons, this strategy is the one with the highest gross premium. So if I'm going out and placing trades and I'm trying to target the highest net target profit, the iron condor happens to have the highest gross premiums, just based on the way it's set up. There's also a minimal chance for additional margin requirements. So when you set an iron condor trade, and it tells you that $960 is the required amount to be able to place that trade, you're typically, in almost every situation, you're not going to have to add more money to that trade because you've already supplied the amount of money that you needed for the margin. So these strategies typically will not have any issues with margin calls. Now, a margin call is where you basically have to add more money to a trade because the risk in the trade changes. And so the broker fears that, hey, this trade's riskier and they've only put up this amount for it, so they would ask you for more money. But again, with the iron condor, you're most likely not going to run into that trouble or have that issue when you're setting these trades. With the iron condor, you know what your risk is. You know on both sides it's that 20 points, and that's what your max risk is on the trade. What I want to talk about next is the eagle strategy. The eagle strategy is something completely different than the iron condor. It is a ratio strategy. And to really explain it, I'm going to bring it up here. With this strategy, with the market still, around that 1950 price, with 49 days left in this particular trade, we are selling 4 call options on the eagle. We're selling 4 options. So this is where the ratio comes in. We're selling 4 calls above the market. On the bottom, we're selling 10. So there's 4 on top, 10 on the bottom. That's the difference in the ratio. As far as the options that we buy to protect us, on the eagle, we're buying 1 call option for every 4 call options that we sell. What that means is that this strategy has what's called a naked option, or it has naked options. You are naked on 3 of the options. So you've sold 4 call options, but you've only bought 1 to protect you, which means you're uncovered. Thus the term naked on the additional 3 options. Here at Option IQ, we believe that markets tend to move up much slower than they move down. We feel that going naked on the top side of the trade is something that each of us have to decide if we're willing to do that, but we believe it's something that can be managed appropriately. And so with this strategy, we are saying sell 3 naked options because you're selling a total of 4 and buying 1 for protection. With that being said, the one that you're buying for protection is roughly about 25 points closer to the market. However, your risk on the top side of this trade is unlimited, technically. It's unlimited because the market could continue to go up higher and higher and higher. So you have an unlimited risk on the top part of this trade. And again, this type of a strategy is only for certain people and only for certain types of accounts, depending on how much capital you're working with. But the top side is uncovered. The bottom side of this trade, though, is almost like the iron condor. We're selling 10 puts, and we're just buying 10 puts 20 points below. So it's the top part that's different. The bottom part kind of looks the same. The only difference is we have to do a minimum of 10. So it's a 4 to 10 ratio is essentially what we're doing. 4 on top, 10 on the bottom. That's where you get the ratio spread terminology that comes from trading this eagle. Now, with the eagle strategy, you're going to make a lower gross premium than the iron condor. So you're not going to target as high of a gross premium. And additional margin might be needed. So on this trade, you could have a margin call. Because you're uncovered on the top, or naked, if the market runs up and rallies and gets really close to where you've sold your calls, you might be asked to put up more money to maintain the trade. That's known as a margin call. And if you don't put the money up, your trade can be closed out by your broker. So in the event of a margin call, either add more money to your account or you would have to liquidate some of your positions to eliminate the additional risk. Next is you know your risk with the purchased options on the put side. On the call side, however, you have unlimited risk. You also have the inside purchased option. So if you think back to what I was just showing you on that strategy, instead of buying your option on the eagle on the outside, like you do with an iron condor, you're not buying outside protection, you're actually buying inside protection. And that inside purchased option can actually increase in value significantly if the market moves up and gets really close to your sold call. Also, the last bullet point, if the put side hits a 40% P factor, there will be a slightly higher loss versus the same quantity on an iron condor. So on the put side, you're going to have a difference where the iron condor would actually perform a little bit better if you hit a 40% P factor and have to exit early with a loss. However, on the call side, because of that inside protection, you typically are going to perform much better with an eagle than you would with an iron condor. A couple of additional bullet points for the eagle strategy. At the top, it says there's an additional exit rule. So in addition to our 40% P factor, our profit exit, or our like 70, 80, 90 profit exit, or the proximity rule, we actually are substituting or adding, I guess, another rule, and that is that if you ever reach 125% of your target profit, that you exit the trade at that point. Because of the inside protection, if the market rallies significantly, these eagles can actually achieve more than 100% of their targeted profit. So that fourth rule is if it hits 125, we want you to get out of the trade and take that profit. Number two, you have to have $10,000 to place that trade in the live market. That's the amount of money that's required to have in your account to place it. Because we recommend that you only put 10% of your total account value into any one trade, we recommend that anyone trading the Eagle has at least a minimum account size of $100,000. The Eagle also tends to execute best, and what I mean by execute best is you tend to get the best entry prices and tend to get into the trade the easiest on a down day. So if you're looking to get into these Eagles, a really good time to do it is when the market is going down. That's the best time to set these trades. And number 4, the Eagle is also good for diversification and trading in shorter dated trades. So these Eagles, we tend to not set them as long. We tend to like to get into the Eagles with shorter time periods because we're hoping that the market rallies and gets really close to our sold calls. Obviously, if it does, our bought call is going to start making money, and we can actually achieve potentially a higher rate of return. So again, that's kind of what we're going to be using the Eagle for. Okay, next what I want to talk about is our third and final strategy. This is called the hybrid. Now, the hybrid strategy is used in volatile markets. That's the purpose of this strategy. And because it's used in volatile markets, we have two types of options that we buy for protection. We have our outside protection, similar to the iron condor, and then we also have what's called the inside protection. The inside protection is the protection that we used on the Eagle strategy on the call side. So we've basically taken the Eagle and the iron condor and created essentially a hybrid version of those two strategies, and we've named it hybrid. So what I want to show you now is kind of break down what we're doing with the hybrid. There's a lot of options on here. There's a lot of what are known as option legs that we're going to be entering. And so I want to make sure that everybody understands kind of basically what this strategy is doing. So if you look at my screen, you have the market at 1950, and we're going above the market. We're selling 4 call options. Notice we cannot sell just one of these. We have to sell a minimum of 4. We're selling 4 of them at the 2065 call strike price. At the same time, we're selling 4 puts at the 1780 strike price. Now, that's just selling options. So we've sold our boundaries, following all the rules. And the next thing we're going to do is, instead of just buying outside protection, we're going to buy some inside protection. Now, why would we buy options that are inside of the ones that we've sold? Well, let me explain why. When we're trading this strategy in high volatility, markets are going to tend to get closer to our sold call and sold put boundaries more often. And because that's the case, we want to add a little extra layer of protection. We call it inside protection. On the call side, we're actually coming down below the 4 calls that we've sold at 2065, and we're buying 1 call 15 points lower at 2050 for the strike price, 2050. We're only buying 1 of these. And the reason why we're only buying 1 is because if we buy more than 1, it's way too expensive. We could not afford to buy 4 at that level because we wouldn't end up making any profit on the trade. We've sold 4, we've taken in some premium. We're going to use some of that money to buy this option. So we're only going to buy 1 at this level. This is our inside protection. Now, at the same time, we're also going to go down and we're going to buy 1 on the put side. And this put option is going to also be bought closer to the market, but instead of 15 points, we're actually going 20 points closer or inside of the put that we sold. And we're going to buy an option at the 1800 strike price. Now, the reason for these options is because, if you look at my screen here, if the market starts to drift up and get too close to the red line on the call side, or goes down and gets too close to the red line on the put side, it's already going to have broke through, and I'm going to actually show you this, it's already going to have broke through that green line that's on the inside there. Everybody see that? It's going to break through the green line. And the same would be true if I came down here and it dropped. Whoop, I came off my pad there, sorry. If it came down and it dropped, it's going to go through the green line before it gets to the red line. Now everyone remembers if we get too close to the red line, we trigger a 40% probability factor, and we have to get out of the trade early. So this inside protection is going to help us when we have to get out of trades early. Even though we're still going to have a loss in almost every hybrid scenario, when we hit a 40p factor, our loss is going to be less because the inside protective option, whether it's the call at 2050 or the put at 1800, is going to actually make some money to help offset some of that loss. So when we take that loss on the hybrid, it's going to be less than what it would be because of the inside protective options and what they do for us. So this is that second layer of protection. Now, because we've only bought one call and we've only bought one put, we don't want to be naked in this trade because we've sold 4 calls and 4 puts. So we still have 3 options that we're uncovered on. So what we're going to do is we're going to go up above the sold 4 calls, 35 points, and we're going to buy 3 more call options as our outside protection. That's going to create a maximum loss, or it's going to basically create a bottom in our trade. At the same time, we're going to go and do the same thing on the bottom. We're going to go down below the 4 puts that we sold. From 1780, we're going to drop down 30 points, and we're going to buy 3 puts at the 1750 for our outside protection on the put side. So that is the hybrid. So now we have 2 things going. We have the inside protection in case we hit an early 40p factor. That's going to help minimize or lessen some of the loss. It wouldn't be as big as it normally would be because of the value of those inside protective options. And at the same time, we're also going to buy the outside protection to create a bottom in our trade, to limit our risk. So this trade is fully covered. It is not naked, which means the maximum risk on this trade is going to be based on how far apart all these points are. But each one of these trades, I believe you end up risking a maximum of just over $4,000 on these trades. That's if you don't get out when you hit a 40p factor. If you don't get out, you let it go through the red and continue on up and let it keep going, and you don't react, the maximum you could lose is, I think, like $4,500, something like that. We'll look at an example here in a minute, but that is the hybrid strategy. As far as the hybrid strategy goes, let's talk about the pros and cons here. It has lower gross premium than the iron condor. So this strategy is not going to take in as much premium, or it's not going to target as high of rates of return or targeted rates of return as, say, the iron condor strategy. And the reason being is you're spending more money buying options to protect you. So it is going to have a lower gross premium. Number 2, additional margin might be needed on this trade as well. This is not a naked strategy, but because the calls and the puts are different, where you're buying protection at different levels, there could be an occasion where you might have to put up a little extra money to cover a margin call that could occur on the call side of your trade. So it is similar to the eagle in that regard. Number 3, your known risk with your purchased option. So again, you've created a maximum risk. No matter what, you cannot lose more than that amount of money. And then number 4, inside purchased options can increase in value. We already talked about that. If the market is coming too close to our sold call or our sold put, those inside options that we bought as protection are going to increase in value and can help offset some of that loss when we get out of the trade.